I'm Karl Kyler, your San Diego Realtor, and we're back for the first installment with Matt.Kish of Movement Mortgage. He's going to give us a full update on where rates are right now, what happened to rates after the most recent Fed funds rate cut on December 10th of 2025, and where we can expect rates to go next. So, Kish, welcome back. Thanks for continuing to join us into the new year.
Yeah, thank you for having me. Happy New Year. 2026 is already here. The holidays were here and then they came and went pretty quick, man. So before you know it, we're going to be into February and this train's really going to be on the tracks. But yeah, looking good coming into the new year. Rates did get cut again, but again, just like we've been saying before, when the rates got cut by the feds, the mortgage interest rates trickle up a little bit, knowing that the Fed rate cut has already been baked into pricing before the rates get cut. So before the rates are cut, prices are pretty good. Rates get cut, our mortgage rates bump up a little bit, and since they've trickled a little bit further back down. But again, here we are in 26 and we're talking about 2025, 2024 things again. Is if you really want to take a good look at where rates are and where they're going, take a good look at the 10-year Treasury. And as you can see, the 10-year Treasury is still hovering above 4%. And as we said, getting it below 4% is really the mark we're looking for to get these mortgage rates into a more favorable position. And here we are, 2026, January, and the 10-year is still above 4. So still waiting for that thing to drop. Still in the quagmire that we've kind of been in the last 4 months as far as rates are concerned. They're trickling down. Fed cuts the rates, they trickle back up for a little bit, and then we get a little more momentum until the next cut. They fall, get a little momentum, they cut. So we're in this cycle right now, and rates really haven't moved much in the last 4 months. They just haven't, and that's predicated by where the 10-year note is.
Yeah, it seemed like rates they kind of built upwards leading into the rate cut. And then I noticed, and correct me if I'm wrong, I'm looking at Mortgage News Daily, after the rate cut, after Jerome Powell spoke, they started to trickle down pretty quickly right afterwards, which I feel like is uncharacteristic of what we've seen over the last, would be 6 or 7 rate cuts, essentially since 2024.
Yeah, it's not that they trickled down too much. It was just kind of the after effect of the rates being baked into what that conversation was going to be with the Fed and when Jerome Powell came out, as well as this was the Jerome Powell's pretty much last stand. There's going to be a new Fed chair. So the expectation of Jerome Powell leaving could have had that effect as well. But even the way the Fed's speaking now and the new votes going forward into 2026, it looks like they're kind of got their foot on the brakes a little bit. Because inflation's ticking back up towards the other direction, just a little bit, not much. And then the unemployment numbers are definitely a lot higher than they have been. So they got a good eye on that as well. So I don't foresee anything, especially in this first quarter, to where rates are gonna drastically go one way or the other, unless there's more world news, right? There's a lot of a hornet's nest being kicked over as far as politically. And so what does different military action around the world look like as far as rates are concerned going forward? And that's something that we're really going to have to take a look at when that time is here.
You mentioned Jerome Powell last stand. He exits the Fed chair position in May, which I think we should be hearing from Trump soon. Hopefully we'll be hearing soon on who he elects as the next Fed chair. So due to the government shutdown, we missed a lot of reports. And when we got the last labor data, it was like optimistic, but even Jerome Powell said that he thinks, and correct me if I'm wrong, I think he said that he thinks the jobs reports are off by like 40 to 60,000. This is a big week right now. Don't we have like a lot of jobs data coming in this week? Do you think that will influence rates at all? Or do you think that's already kind of baked into the market already?
It's already baked into the market already. I don't expect these kind of job numbers to really be too different than what we just saw. But again, because of the shutdown, we didn't see the drastic figures for a couple months that would have really moved those markets, right? Like the October report and the November report. So those reports really, I think, would have really shifted things had we got them in real time. But the fact that we didn't can't really bake in pricing on past events, right? So going forward, again, I don't really see much movement in the first quarter, especially when we know we're getting a new Fed chair. So I could see if we do get a Fed chair and it's somebody that our president is thumbs up with, I could see that person kind of going in heavy to appease, the masses. But again, I think it's going to be really data driven out the gate, and there's just not much data to move anything right now.
Got it. So to recap, and I'm going to simplify it, well, probably horribly. So course correct as I do go. Essentially is we don't have enough data and the markets are waiting for Jerome Powell to get the heck out of there so that we know what the next Fed chair, because it's expected that the next Fed chair is going to make some pretty significant changes. And I haven't checked it probably this week, but the CME Fed Watch tool, I think the last time I saw it in December, it was like a 25% chance that the next rate cut of a quarter point would happen at the end of January, I think it is. So the markets, you're suggesting that even with all the data that we do have, the markets are more likely just to kind of hold place. Is that what you're suggesting?
Yeah, I expect it to stay pretty flat for the next couple months, right? Unless there's really something, again, in these world markets or a world event or something here at home that happens to kind of trigger, the next step. But again, with the cuts leading up to the end of the new year, a new Fed chair coming in, a lot of uncertainty in the labor market and with inflation. So I really think it's a wait and hold kind of period right now in this first quarter. I don't really see the Fed making a bunch of moves up the gate. I really think it's going to wait and see some data, kind of build up and see where that data takes us before they make their next move.
Matt, you make a really, really good point. Like if you're not expecting much, which I'm kind of on the same boat as you, if we're not expecting much, like everything's just going to hold, it seems like right now would be a really, really good time for buyers who have been kind of sitting on the fence to maybe take that first step off, look at getting their pre-approval and start scouring the market, because once the new Fed chair comes in, if they're a little bit more aggressive and they're trying to just drive the economy a little bit more, they slash that Fed funds rate, it could be the case that mortgage rates will be, I don't want to say significantly lower by the end of the year, but lower enough to make a impactful difference on a mortgage payment. So if a buyer can get off the fence now, they're essentially getting ahead of that rush of the buyers that will eventually be able to qualify. Do you feel, or what are your thoughts of that stance? Like, do you think that's pretty reasonable to suggest, or do you have a different perspective?
Well, I really think if you were on the fence and you were, had one toe into the water of really looking into what a new home or a new condo or a new townhouse looks for you, I really think it's even more so you should be two toes in now, right? Because we're seeing a lot of properties that have come to the market, they're sitting for a while, right? So negotiation on properties that have been sitting around for a little while in this market already gives you a leg up. Economists and forecasters and people in that realm are only forecasting rates to kind of trickle down into the high fives. Maybe 5.73 is kind of where they're saying the average might be for 2026. And that's not much lower than where we were at the end of 2025, the summer of 25. So if you already are one toe in, you should be whole foot in now, because you kind of know the market hasn't really gone too far one way or the other. Affordability has pretty much stayed the same for the last 6 months, right? It really hasn't shot up, and it definitely hasn't drastically come back down. So we've been living kind of in the same place for the last 6 months. So what has that last 6 months done for you? Have you been able to save the right way? Is a jump in a monthly payment something that's still comfortable for you? Again, I don't foresee, and even these economists don't foresee, the market moving in a place that's really gonna, be a point less than where they are right now. It's gonna trickle down to maybe into the high fives. So again, if you could find a space where we're at right now where you're comfortable, then you're going to be that much better moving forward. If rates do kind of trickle a quarter point, a half a point lower, you're going to get even more affordability going forward. But we're kind of living in this area right now for the foreseeable future. And what does that look like for your financial well-being going forward? Let's talk about it. Let's figure it out. Let's get a game plan together. Again, if you've been looking since June, things really haven't changed much, other than properties have sat there a lot longer with a little more negotiating power with them.
Absolutely. Yeah, I think the last forecast I saw from either Fannie Mae or Freddie Mac was rates to be like 5.95 or 5.99. So even considering, because they're on the front lines of all this data as well, even considering a new Fed chair, they're not expecting the bond market to have such a swing that is going to influence mortgage rates to come down real dramatically. So if you're out there expecting you get a 5% rate, like 5.00 or lower, you might be sitting in the clouds on that one. Now, in regards, just to add a little bit of context, Kish is right. We do have a lot of inventory that's just standing around right now. I did an open house at a property that's been on the market for like over 6 months. Now, mind you, it was 2.5 million, right? So there's also a price point, category that's sitting a little bit longer. But our condo market has relatively grown pretty significantly in comparison to the detached market. The detached market at the entry point, which is about 1 million, is going pretty quickly, and I'll say quickly very loosely, in comparison to the condo market. So if you're looking at your first home and you want to go into the condo space, you want to go into something that has minimal maintenance, where you don't have to worry about a roof, you don't have to worry about termite, you have your grounds maintenance, that's all covered by HOA. You have your insurance that's supplementally covered by the HOA. Right now might be a good time just to start the conversation with Kish. Now, Kish, before we wrap this up, we have inflation's up. You mentioned that earlier. It's trickling up. I think it's 2.8 right now. Correct me if I'm wrong on that. We have unemployment. The government or the Fed, I guess both, were suggesting that they were concerned after 4.3. It's at 4.6. And then we had GDP come in at 4.3%. So we have inflation up, unemployment up, and then GDP up. It just sounds like those sound kind of weird happening together. With that going on, does that have any impact on your personal perspective on where the economy might be driving mortgage rates next?
Yeah, I mean, unfortunately, bad news in the economy is kind of good news for mortgage rates. So if we see inflation trickle up over 3, if we see unemployment, go up towards 5, if we see those factors kind of come into place, we might see the Fed have to move and really make a difference in the rates as far as mortgages are concerned. But right now it's not significant enough out there for them to really start panicking. It's just the data is starting to point in a direction to where the economy is slowing, right? And so what does that look like, keeping the Fed funds rate where it is? What does it look like not putting money back into the economy and the government maybe supplementing mortgage bonds again? You know what I mean? So what does that look like going forward if we kind of just stay the same course? I have a feeling, again, at least in the first quarter, it's going to be a lot of the same as we've seen the last 6 months. So yes, unemployment and inflation, those are really something to look at. CPI and PCE as well. If those things are cooling, what does that look like? So there's a lot of factors. And now that the government isn't shut down and we're going to be getting this data over and over and over again, hopefully, we could really see what the Fed and a new chair is going to do with this information. But right now, with Jerome Powell still in place, and with the, like you said, it was a 25% chance that the Fed does anything this month, I could see that trend going forward for the next few months.
Wonderful. Well, Matt, thanks for the update as we move into 2026. These are invaluable to the audience. If you're thinking about getting off the fence, give Kish a call. I have his contact info in the description below. In addition, if you are looking for an update on the San Diego number specifically, keep an eye out, subscribe and like this video, subscribe to the channel. I'm gonna drop the San Diego Market Matters, which comes out almost every Sunday. And this upcoming Sunday is gonna be a deep dive into the San Diego figures. So you're gonna see exactly how 2025 closed out, what we can expect going into 2026. This coupled with what Matt.Kish talked about today will give you the fuel to make the right decision going forward for your financial future with regards to investing in real estate. If you have any thoughts, questions, concerns, don't hesitate to reach out. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.